Now, business data analytics, August 2024, question 23. The question reads, Follicle Manufacturing Limited produces premium jewelry. The company prepares its budget for the year based on the estimated production and sales for its products. The following budget was prepared for product Malkia for the current months on the production based on the production of 1,250 units. However, due to unexpected demand, the company ended up producing 1,500 units. So they ended up producing 1,500 units. So this is the budget based on 1,250 units. Then this is the budget based on 1,500 units. Additional information. The selling price of Malkia is 230. Where necessary, use the per unit variable cost derived from the budgeted figures. Follicle Manufacturing Limited has sales contract to deliver 850 units of product Malkia every month, so 850. Follicle Manufacturing Limited sales averages 80% of the units produced in any month. This percentage is inclusive of the sale contract units. Corporation tax rate is 30% payable on realized profit. Required, prepare a flexible budget for 1,500 units. Determine the total flexible budget cost for 1,500 units. Number C, at 1,500 units, compare the flexible budgeted cost with the total actual cost. Using the logical function, identify the variances as either adverse or favorable. Number D, prepare an income statement for manufacturing levels of 1,000, 2,000, and 2,500 units of product Malkia. So, solution. So we want to finish our solution. Do our solution here. So, solution. The first part is this, Control C, Control V. Prepare a flexible budget for 1,500 units. Now in doing this, calculate the flexi, get the flexi budget factor, which is given by actual units produced divided by budgeted units. So the actual units divided by the budgeted units. Actual units over the budgeted units. And actual units. You also have the budgeted units. Actual units were how much? Actual was 1,500, 1,500. Budgeted was 1,250, 1,250. So flexi budget factor will be equals to sign 1,500 divided by 1,250. That gives us 1.2. 1.2. We can proceed and say now flexible budget is equal to flexi budget factor times budgeted amounts times the budgeted amounts times the budgeted amount, then flexible budget. Okay, then just pick what you have from, then give us the values. The values as given in the budget, direct material, enter. So from direct material to the last one, yeah, that is direct material to the last one. Now to get the flexible budget, we will simply multiply the budgeted amounts as given with the flexi budget factor. So that will be equal sign, go to the budgeted amount, like the direct material, times the 27,000 times the flexi budget of 1.2, the flexi budget factor of 1.2. Then drag down to direct labor. I need to lock something. Lock the flexi budget factor. Lock the flexi budget factor, then enter. Drag down to direct labor. Drag down to variable manufacturing overheads. Fixed is fixed. So fixed, we don't do that for fixed. You can just copy all the way to fixed sales and distribution. You're going to change fixed because fixed doesn't change. So change this. Fixed manufacturing overheads will be equal sign. Pick the one that was given. Fixed manufacturing overhead is 75. Enter. Also change the fixed sales and distribution, equal sign. So use the one that has been given here as 65,000. So 65,000 remains as it is. So that becomes our budget on the information that has been given. Total will be a summation of all. So alt equal, add, and you get your total. You can ask how we got the flexible budget. You multiply all the items, the budgeted amounts, with the flexi budget factor, except the fixed manufacturing overheads and fixed sales and administration expenses, which are used the way they are. Part B, determine the total flexible budgeted costs. So number B, determine the total flexible budgeted costs of 1,500. So total flexible budgeted costs of 1,500. Determine the total flexible or budgeted costs of 1,500. So the total is already given. I don't know what they want, but we can simply get that total, which is already given. You simply say equal sign, then click on everything here, everything on the other side. So you use it as it is, equal sign, then click on what, everything that we have up there, and that is 0, drag across, drag down, all the way to the total. That is the total that was required. So that becomes the total. It seems the one above, they didn't want the total. Determine the total flexible budgeted costs. The total is here already. We can remove the total. You remove the total on the first one. Then now the total that they wanted is here. You sum the total. Enter. So this is the total that they wanted. Part B. Part C. At 1,500 units, this is part C. You can copy this all. So at 1,500 units, compare the budgeted costs with the total actual cost, and using logical function, identify the variances as either adverse or favorable. So identify the variances as either adverse or favorable. So here we'll have equal sign, then move up and pick actual. We have the actual for 1,500, actual, or they want us to compare. Well, let us start with the flexible budget. Start with the flexible budget. This is the flexible budget. Flexible budget. You can call these details flexible. Then this is actual. Actual. Equal sign. Actual is up. Actual was given in the question. This is the actual for 1,500 units. Enter. Then drag that down for actual. Now, once you have this, the other side is the total. Get the variance. Variance. Type of variance. So what is the difference between actual and what we have on the other side? So we said under the type of variance, remember variance is the difference between actual and a flexible amount. Then the type of variance will be equal sign if tab, if this variance here is greater than 0, comma, then quotation marks, then if that is greater than 0, then it's adverse. Remember, this is a cost, so it's adverse, comma. If, again, the same cell now is less than 0, comma, then the answer will be favorable. Favorable if it's less than 0. Favorable. If it is less than 0, it's favorable. Quotation, comma. But if it doesn't fall, there are those which are just 0. If it doesn't fall in any of those, then the formula will keep quiet. So you just say quotation, open, quotation, close, and then close bracket. Close with 2 brackets. So if that cell is greater than 0, then this will be adverse. If that cell is less than 0, it will be favorable. But if it's not any of the other ones, then two quotation marks, it will be quiet. And you can see the first one is favorable because it's less than 0. Just drag down. So the last part, there it is. Prepare an income statement for the manufacturing levels of 1,000 units, 2,000 units, and 2,500 units of product Malkia. They want an income statement for that. Now remember, there was an information that was given. These were manufacturing levels of 1,000, 2,000, and 2,000 units of product Malkia, the units produced. Now there is a statement here where they said that the selling price per unit for product Malkia is 230, where necessary. The per unit variable cost derived from the budgeted figures. There is a sale contract deliver 850 units, and Folco Manufacturing Limited sales averages 80% of the units produced in every month. This percentage is inclusive of the sale contract units. So we want to start by getting the per unit variable cost from the budgeted figures. So per unit, start by getting per unit variable costs from the budgeted figures. Per unit variable cost from the budgeted figures. So we have some items like direct material. Another one will be direct labor. Another one is variable manufacturing. Then finally we have variable sales and administration. Now these are fixed. The other two are fixed and they don't have per unit. So what are the per unit variable costs from budgeted figures? So direct material will be equal sign. Scroll up. And you can see budgeted here. Just take 27,000, divide that with 12,050, 1,250 per unit variable cost from the budgeted figures, and that will be 21.60. You can drag down to reflect the other one, 20. Then variable will be different. You take equal sign, go to the variable budgeted figures, 12,500 divided by 1,250. I would have dragged that one down as well. That is 10. Then finally, variable sales will be, now the variable sales is 18,000 this divided by 1,250 again. Now they said here that where necessary, use the per unit variable cost derived from the budgeted figures, where necessary. So that's what I'm doing. That is the items that will help us in this income statement. Then the name of the company is this. Manufacturing Limited. The title. Then they want income statement for these levels. So income statement, or you can call it the statement of profit or loss, same thing, statement of profit or loss. Then start with manufacturing levels. Now under manufacturing levels, they want one for 1,000, 2,000, 2,500. Those are the manufacturing levels that were given. So statement of profit or loss for the following manufacturing levels. Once you have the manufacturing levels of 1,000, 2,000, and 2,500, we go to sales, the units produced. Now has a sales contract to deliver 850. So it means the minimum you can deliver is 850. So then the sale averages are 80% of the units produced, but the minimum is 850. So it's 80% of the units produced, but a contract says that a minimum of 850. So that's what we are going to see here. Now, units sold. This will be units sold, units sold, units sold. Now there's a formula that we bring in. Equal sign, max, 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 then click on 1000 times 80%. Remember they said it is 80% of the units produced of the manufacturing levels. So 1000 times 80%, but there is a contract that you must supply a minimum of 850. So maximum between the 1000 times 80% and 850. Enter, and you can see the first one is 850, but the others have gone for the maximum. Sales price per unit. Sales price per unit, 230. So 230, and that is the same on the other side, 230. 230 as given in the question. That is the sales price per unit. We can cut this, Control X, then Control V. The now variable cost, put together the variable cost. Variable cost, the variable costs per unit. So we are talking about variable cost per unit, variable cost per unit. We have them arranged here. Enter, then give them, have them as they are, all the way to variable sales and administration expenses. Then equal sign, variable cost per unit. So get the variable costs per unit. That will be equal sign. Then click on this and lock. Enter. That is 21.6. Drag across. Drag across. Same to direct labor, equal sign. Click on 20, lock, enter. Drag across. Same to the other one. 10, lock, drag across. Same to the last one, 14.40, lock, then drag across. Drag across. Now what is the total contribution per unit or total contribution? Total variable cost, total variable cost per unit. Total variable cost per unit. Sum all the variable costs. Sum all those variable costs. Then drag across. Total variable cost per unit. Then get contribution per unit. After this, we go for contribution per unit. Contribution per unit. Now contribution per unit will be equal sign the 230 minus the total variable cost per unit. Then that will give us 164 for each case. 164. Then total contribution. Total contribution, that will be the contribution per unit, then multiply that with the units produced. Units produced. Units produced. Units produced. I think there's something that. So remove this. You'll also be removing the contribution per unit. Remove the contribution per unit. Remove the contribution per unit. Now give me the sales revenue. Sales revenue. Sales revenue. Now sales revenue will be equal sign the unit sold times the sales price per unit. So unit sold times the sales price per unit, enter, and drag across. That is the sales revenue. Then total variable cost. The total variable cost will be equal sign the units produced, the manufacturing levels, times negative manufacturing levels times negative the total variable cost per unit. That is the total variable cost per unit. Total variable cost per unit, enter. That is 66,000 here, drag across. Okay, you can reduce the decimals to your level. Profit before tax, the profit before tax, will be the sales revenue plus the total variable cost. So sales revenue plus the total variable cost. That is 129,500. Then you drag across for that cost. So we've omitted the fixed cost. So undo, undo, undo. So there is sales revenue. There is total variable cost. Then now give me the contribution. This will be contribution or profit. Yeah, contribution. You can call it contribution. Total contribution. Alt equal. Then that is the total contribution. Then I had omitted equal sign. There are two things at the top. Fixed manufacturing overheads, and again equal sign. The other one is fixed sales and administration. So those ones had been omitted. So you lock them because they are constant. Equal sign negative. The first one is 75. I had to lock. Make sure you lock. Then drag across. Then the other one is equal sign negative. The last one is 65, lock, constant throughout, then drag across. Drag across. So you can decide to have this as a one format, which looks good. One format here, that way, then centered as well. It doesn't change any value, just that we picked a different kind of format there. Now profit before tax, our profit before tax will be equal sign contribution. Since they are already negative, you simply add this and also add the other one. And you are going to get 10,500 here, then drag across. That will be our profit before tax. Then finally, the income tax expense. Income tax expense. It was 30%. Tax was 30% where there is profit. So we'll use the if statement, equal sign if tab, again, equal sign if, then tab. If this cell is greater than 0, comma, then take the same cell times negative 30%. Otherwise, the answer is 0. Otherwise, the answer is 0. So you don't tax that loss, then just drag this across. Now get profit for the year, which is the last thing, profit for the year. Profit for the year is what we've gotten there. So that is the last part that we have solved on that question. Yeah. So that is it. We want to adjust something, the variable sales. I want to put together all the variable. This will now be all the variable items before you move to the last one. So I'm removing all this, cleared. And here, now give me the sales revenue. Sales revenue. Just give me the sales revenue. Sales revenue. Now what is the sales revenue? Sales revenue will be equal sign units sold times before the sales revenue, I think it's important to have what we had on the other side, the sales price per unit. So those are important because we need them. Sales price per unit are important. Then now sales revenue will be equal sign 230 times the unit sold. Then that will give us this 230 times the unit sold. Then give us the variable cost. Variable costs. Let us put together the variable costs. Total variable cost. Start with the direct material. So direct material will be what we have up here, log it, times give me the manufacturing levels of 1000, then drag across. This one will be dragged across. That is the direct material. Then the second part will be direct labor. Direct labor will be 20, log the 20, times the manufacturing levels of 1000, then drag across. From direct labor, the other one is what? Variable manufacturing overheads. Variable manufacturing overheads will be equal sign 10 times, so 10 times the units sold, the manufactured units, that will be 10,000. 10,000. Is there any other variable? Variable sales and administration. The one that follows is variable sales and administration. Don't leave it out. Don't leave that out. Now, I did not lock this. You need to lock something here before you drag across. Lock this. Now, variable sales and administration will be the 14.4 times the now unit sold, because it varies with sales. It varies with sales. Multiply with the unit sold. Enter, then drag that across. Then what is the total variable cost? Again, I've not locked this. So lock this before you drag across. Then sum to get the total variable cost. total variable cost. Then after total variable cost, we get contribution, total contribution, and total contribution will be equal sign the 195,500 minus 63,840 and drag across. Then after that, give us the others that were fixed. The others that were fixed. Fixed manufacturing and fixed. The last one is fixed sales and administration. Remember, those are fixed. Equal sign negative. So the first one was fixed at 75. Lock that. Drag across. The other one was fixed as equal sign negative. The last one was fixed at 65. Lock that. Then drag across. Believe this should also be negative, so equal sign negative, so that it gives us a negative figure. Then now this will be summation. You simply add those two to get the same answer. The answer is the same though. Now what is our profit before tax again? Profit before tax. Sum this. Alt equal profit before tax. It changes. Profit before tax. Then now income tax expense. Income tax expense will be equal sign if tab. If this cell is greater than 0, if that cell is greater than 0, comma, take the same cell times negative 30%, otherwise the answer is 0, close bracket. And that will give you 0, then drag across. Then profit for the year. Profit for the year, summation of this. So that becomes our final answer. You can see the answer is different from how we had done it before. They are not the same. I hope this is the correct version of how that question is supposed to be handled. The reason is the variable sales and administration expenses, they vary with sales. They don't vary with the units that were manufactured or produced. They vary with the sales. If you make that assumption, then this is the correct version of our question. That is it. The brain is now straight to the limit, and that is how August 2024 question 23 was supposed to be solved.